If you're paying close attention to the economy and interest rates, over the next couple of weeks you might hear about the R-star. Is that some type of black hole calculation that you missed during the 3-hour Oppenheimer movie? No, it's even more confusing than the physics of the Oppenheimer movie. I'm Jack Aitley from Jack Aitley Real Estate and the Online Real Estate Academy. Let's take a look. So I've been keeping a close watch today on the 10-year Treasury, which usually tracks along with mortgage rates. And wow, it is now surpassing October 22 numbers, and basically it's the highest it's been in a really long time, as mortgage rates have also hit new 20-year highs. Mortgage News Daily has it at 3.73. Google has a $500,000 loan with 20% down, 800 plus credit. These are yesterday numbers at 7.426, the 30-year fixed. Ouch. So, Jack, what's an R-star? What is that? The R-star is effectively the neutral rate of inflation. In other words, the rate by which it doesn't encourage the economy to expand or contract. In other words, the economy hits an equilibrium. Okay, so why is that important? Because if the R-star goes up, then the Federal Reserve would say to themselves, then we need to keep interest rates higher because of the new structural changes in the economy. In other words, rates higher for longer. It's also possible that while the R-star might not actually go up or go up even that much, it might be used as an excuse to keep rates higher for longer. Because notwithstanding all of the rate hikes and the supposed credit tightening that the Fed is depending upon on slowing down the economy isn't slowing down as much as people had expected. Check a look at today's job numbers. U.S. jobless claims applications fall as labor market continues to show resiliency, Associated Press. Part of the Fed's reasoning was for hiking rates was to cool the job market and bring down wages, which in theory suppresses price growth. That theory hasn't worked as well as they had expected. So what's driving this inflation, Jack? Well, it's government spending. Government spending, for the most part, is driving inflation, which, of course, is not controlled by the Fed. Now, the Fed, rather than the market, the Fed is trying to guess, like levers on a machine, about how fast or how slow the economy should go. Rather than have the economy figure that out on its own, instead they try to factor this by using the R-star calculation. That's why you see articles like this. Opinion piece from Jamie McGeever. Column, markets clamor for R-star signal from Jackson Hole. That's where the Fed is going to have their big policy conference coming up this month. Mr. Goldberg from TD Bank Securities notes that pre-pandemic consensus R-star relatively low with a wide uncertainty band. Now it's relatively low with a huge uncertainty band. Basically, the economists are admitting that they don't know what's going to happen. It could explain why economists like Goldman Sachs, Citi, JP Morgan, and others have pushed back or removed their recession calls, and feeds into the view that the Fed may not ease policy, cut rates, at any time soon. If the Fed pushed the argument more efficiently that the R-star is going up, it would reduce the urgency of cutting the funds rate, Goldman Sachs strategy said. CapitalGroup.com in June said, the Fed has been signaling it wants to move away from ultra-low interest rates and reserve quantitative easing for real economic emergencies. Mini bank crisis, which they themselves actually caused. Any indications that the R-star might be rising would make it even harder to justify aggressive rate cuts. Another way to look at this is that this whole R-star thing is just an excuse so that economists can blame something other than themselves for the fact that central bank control of the economy doesn't always work that well. In fact, back in 2017, JP Morgan said the exact same thing. Whether the R star is on the rise or not, central bankers are talking about it and even using it as a reason to shift policy. Meanwhile, the federal government has announced plans to borrow more money to fill the growing gap between tax revenue and government spending. How do they borrow more money? They issue more 10-year treasuries. Bill Ackman said, "Large deficits as far as the eye can see," he told the Financial Times. Meanwhile, Pershing Square chief executive said, "It's hard to imagine how the market absorbs such a large increase in supply without materially higher rates." And today's Financial Times, Treasury yields near 16-year high as bond market shifts from low rate error. Maybe they meant low rate error, as in ERROR. It feels like we're making a case for a real market break from the post-financial crisis period when rates were kept so low for so long, said Alan Ruskin, strategist at Deutsche Bank. As yields on the 10-year Treasury, as we saw today, started off this video with, hit their highest level since November 2007. So we're looking at higher for longer, and the R star is basically going to be used as an excuse to keep it higher for longer rather than look at the real structural problem, which in the beginning of this video I said that this was more confusing than Oppenheimer physics, because effectively what we have is a system where the central bank tries to make all the decisions, and basically that doesn't work that way, as we can see in the economy today. Rather than the infinite number of decisions that are made by a market, rather than that, and those happen every single day, rather than that, we have a government bureaucracy that tries to make incremental decisions on a month or every other month basis, and that can never be smarter than the actual millions of decisions, tens of uncountable, infinite number of decisions that the market makes every single day if interest rates were allowed to float freely in an open marketplace. Of course, it would be really nice if we stopped spending ourselves into oblivion. This is a chart of the total public debt as a percentage of gross domestic product since 1966. And yeah, we're at about 120%. Ooh. All right, I'm Jack Gately from Jack Gately Real Estate and the Online Real Estate Academy. We'll keep you posted. Thanks for watching. Have a great day.